Hello, everyone, and welcome back to the Property Trio, the podcast for the informed buyer, investor. What is it, Dave? I always mess this up.
You've done
Sophisticated
really
property
well.
buyer, Mike.
Sophisticated property buyer. I'm going to have to write that on my screen. I'm trying to throw it in. Anyway, let's get on with it because we've got a big episode today. Firstly, I should say hello, Dave and Cate. It's Market Update. Excited?
Yeah, we are.
Always love a
super
market
excited.
update.
Well,
Dave has tethered the caravan. He's sitting here in, base control with the whole setup.
Yep,
And we've
up in
been chatting.
Yeppoon, just off Rockhampton. Yeah.
Awesome. You're coming back down.
No, we're still on the way up. We come back,
Okay.
start turning around, came back down about a week or so.
Yeah.
Can't
great.
help but notice you're in a T-shirt and I'm envious. So we'll just move on from that. So July, the month it was, and hot off the press at the time of recording, we had a rate cut yesterday. Unfortunately, only 25 basis points. I mean, I've been sort of pleading the case for let's swing for the fence and let's do a 0.5 or, gosh, I don't know, 2%. Let's get weird with it. But the Bullock has said there's probably a couple coming. So obviously she's a conservative character and very measured with what she's wanting to achieve there. And we'll get to that in a moment. But let's start with the monthly print. It's a big story about Darwin for me, 2.2%.
I think for everyone.
Yeah, for
That's
the month
big.
of July, 2.2%. And if you annualize that, we're talking 26.4% if it carries on that pace of growth, which is an enormous amount of growth. It begs the question, how lagging is this data? How long could we expect it to go? Still annual growth only at 8.5%. But if it continues that pace, we'll be galloping into double digits and probably 20% plus. Cate, I'll start with you. What, apart from Darwin, what's the standout for you?
Everything's in positive territory. Absolutely everything. And, at my coalface, it feels like Melbourne's absolutely got traction. But when I look at this chart, everything's got traction and more traction than Melbourne except for Hobart. So Hobart's got a very tiny gain of 0.1, so it's pretty much in balance. Melbourne's got 0.4. Now, that's not setting the world on fire, but it's been consistent. We've had gains averaging that since the start of the year every single month. And obviously this is a median. It's not the properties that a buyer's agent picks out to target. So my coalface is very different to the median coalface is the point that I'm making. But it's across all dwellings as well. And obviously Darwin's absolutely galloping, but Perth at 0.9, that's not curling its toes up at all. The Perth market is still moving as well. And when I look at median values, Darwin's is the lowest by a country mile at 549. And it's a galloping market and the returns are really good. A lot of people would argue that, that's a really magic trifecta there, that there's a big differential in median values. There's a perception of value, there's extraordinary capital growth, and there's really attractive rental returns. So tick, tick, tick for Darwin, except a lot of us are looking at it going, yeah, but we know what it did for the last 10 years. So I think, we can get excited about Darwin and it is an exciting story. But a lot of people are looking at the big picture and saying, well, it's doing well now, but it has been a volatile capital city and it's a very small population compared to all of the others.
Yeah, about 150,000 in population, so it's a pretty small centre. And it's had a go at the top of the table in terms of median house prices, now bringing up the rear. I wonder if by the end of the cycle it'll have overtaken Hobart. I think it's within possibilities, but those two are really trailing behind. Dave, what's the standout for you?
Yeah, look, the Darwin numbers don't come as a surprise. I think once we did that deep dive episode, I certainly expected property prices to move in Darwin and said that on that episode, and we've discussed that within our business and with clients, and I think it'll keep running for a long period of time to come. And I think it's well on its way to probably exceeding 20%. We were saying 10 to 20% with our expectations, but I think it's probably going to go beyond that. But as Cate spoke about, it always comes with that risk that, once it finishes, how long is it going to be in that at that price point? How long will it sit there? Will it sit there for another decade like it just has, or more?
What I do want to do is just top up Dave's comment about the deep dive on Darwin. It was actually initiated by a lovely listener question from William, who corrected us for talking Darwin down and suggested that it had already turned and that he was, getting data from the coalface. And William, you were absolutely correct. And I think it's incredible what you were able to send through to us in detail, and then we could, really capitalize on that already to dive into the right areas and capture the data to be able to have that ep on Darwin for our listeners. So thank you.
Yeah, I like that. It's keeping us honest. I suppose nothing really changed so much rather than us looking into it going, yeah, actually it could really explode and is likely to explode. But I would still sort of say neither of us kind of said this is a market that we see as being stable and safe and a good blue chip investment for people. It's the worry about if you mistime this, what happens and how long are you sitting on your hands? And that's the $1 million question, right? But the history of Darwin is kind of saying it has these big peaks that are tied to the resources and can have a long time in the wilderness. One thing that stood out for me is the change in dwelling values over key time periods. And this is the graph that CoreLogic gives us about the markets that are at their peak. I want to go to you on this one, Dave. Change in dwelling values. We've got the majority of markets are actually at their peak. As Cate mentioned, Perth is still humming and it's at the peak of the market, still printing growth. Brisbane, Adelaide, Perth at peak. Interestingly, Sydney's at the peak of the market, Darwin as well. And so, and across the board, nationally, both the combined capitals and combined regions are at the peak. And that sort of begs the question, well, what have we got left? We've got Melbourne, it's 3.4% down from its peak of March 2022. Hobart peaked in the same month, but it's down 10.4%, which is very, very interesting because typically in downturns from a national point of view, we don't really go above 7% historically. I don't think the national market has ever contracted double digits, but Hobart has. We got Canberra at 5.2% down, again, peak May 2022, and then you could throw regional Victoria in the same sort of bucket there. Regional Tas and Northern Territory we don't talk about too much, but there's been a while since they've been at the peak as well. That's a bit of an unusual read where we've got so many markets at the peak. I wondered if you had a comment on that, Dave, or perhaps Hobart being 10.4% down, and it might be begging the question, well, when is its time in the sun? Because at the RBA conference last week, Cate and I spoke to both Simon and Terry, who are property forecasters. Simon said he hadn't seen much data to be excited about Tassie. And Terry said that he's seen some listings activity or sales activity that pointed to him that it could be on the verge of a rebound. I'll leave that up to you. Choose your own adventure.
Look, I think, it comes as no surprise to me with the numbers that Darwin is showing. I think that's going to continue for a long period of time. We've certainly been talking to our team and investor clients about Darwin since we did our deep dive episode. I think it's going to run. It's looking more and more like beyond 20% now. Probably the big question for investors is we've got 8.4% growth since Feb 25. So I've been tracking all the capital cities since the first rate reduction because I wanted to see what the markets have done since the rate reduction. That has it, at 8.4%, but we know the data lag occurs. So the question for investors is, are they getting in on the ground when the market's already moved 20% or 15%? I think that's what you want to assess. And so you need to do your due diligence and look at what are you paying relative to what comparable properties sold for 12 months ago, 18 months ago, 24 months ago. because
It's
I
a
think
tough
that's
one though, isn't it, Dave? When you're watching a market run, if you're trying to time something, and I'm not suggesting that timing the property market is like feeding a poker machine, but there is that element of gamble related to it, because you can look at it and say, well, it's already done 10%. It's gone. I'm not going to touch it. And then it does another 30. Or you can say, I'm jumping on this horse while it's galloping, and then it stops and you've bought at the peak of the market and you're exposed. And in fairness, I'm one of those people that did that with Hobart back in 2008. It had been doing so well and I was so excited. And then I was holding the hot potato, waiting for its next cycle. But am I upset about that now? Almost 20 years later? Not at all. I've had some really good gains with my properties in Hobart, but it's a very difficult way to look at it. And I think when it's a long-term proposition, it kind of it smooths the risk anyway. I'm not going to say it takes the risk away. The challenge with Darwin is it is either volatile or cyclical, whichever you want to call it, and it's so tied to the minerals in the resources sector, and you could argue that it's not a diversified enough of an economy. But if it's got all of the fundamentals right now for this run and you're comfortable with that, well, then maybe it is a good idea to jump on it if it works for your strategy.
Yeah, I think for us, being an independent company, and because we don't buy or sell property, so we have that complete independence. We're a national company. It's negligent of us not to talk to our clients about all different strategies. And, some people will want to get into Darwin, and therefore, we shouldn't stop people from heading down a path that they really want to head down, because, we might not do it ourselves as individuals is essentially how I would say it. And I'm not saying I wouldn't do it. I think, I think it's not a bad time if you get in early enough into Darwin, and if you have enough of equity build up and you're in a really strong financial position and you want to take a little bit of a risk and try and time a market, I can see why people are entering Darwin. I think another factor is occurring, which we've alluded to a few times, is I think with the growth of buyers advocacy in Australia, and certainly some bigger buyers advocate businesses who are more willing to take bigger risks, I would say, with the properties they purchase, I think that they can move markets now. And particularly, really we only have maybe 6, 7 or 8 large cities in this country. The rest of the cities can be, I think, the markets can be moved by a big enough collective of buyers agents getting into that market. So what I've started to think about is what happens down the track if these buyers agents have got people into a whatever it might be, Darwin, Townsville, whatever the market is, and then it's flat for 5, 7 years. Do they have the ability to move that market again down the track? Because they'll be motivated to do that if they have lots of clients who are unhappy. That's sort of the down. That's the down the river. Yeah. And can that now, if we've got such a big ecosystem of buyers agents, can that continue to perpetuate?
That's the big question
potential
we've
it
been
could.
talking about for a couple of years. And this conversation for me started probably 10 years ago. And the answer was it has to be a smallish market, and probably thinking populations around 30,000 or less was the sweet spot. But I think we've almost certainly got incontrovertible evidence that Darwin is not too big to be able to be moved by buyers agents at 150,000. So it's just a question of how big is that number before it kind of trails off. I think Sydney's too big, Melbourne's too big, Brisbane's too big, can have an influence. But when you've got 150,000, I think it's definitely small enough for buyers agents to come in and make a big difference.
Especially when you take into account market segmentation and price segmentation. If everyone wants an entry-level priced house well, that tiny segment, that 500 to 600 or whatever it is, that will absolutely explode. So, you're putting things under a microscope and reducing the total number of dwellings that are targeted by a horde of buyers agents. That will speak volumes.
And I think the evidence is showing us that the average transaction value for these buyers agents might be above the median, because I think we discussed that last a couple of episodes ago, Cate, where I was kind of saying, everyone's telling me Melbourne's hot, like there's quite a lot of competition, there's heaps of buyers agents that are active, but we're not really seeing the growth gallop along. And then you were saying, well, it's probably quite likely because the median is about 800,000. Most of those transactions would be sub that amount, and maybe these investors that have got a 650 budget with Darwin's median at 537, is it, or 549? They could potentially be buying at that 650 mark, and then they're pulling those numbers up.
Yeah, it's an interesting thought. We need to delve way deeper into it. And I think some conversations with local agents would be really insightful as well.
I think what we would want to track, I've been thinking about it, travelling through and around some of these cities and talking to people who live near some of these cities and have spent time in them, and just what their perspective is of communities versus what some buyers agents might be talking about and how they differ. But I think what we need to track is the percentage of properties that are owned by investors. I think that's one key thing to look at, because what happens there's got to be a tipping point where owner-occupier, there's too many investors inside some of these regional locations, and the locals, the true locals, get priced out of those markets. What happens then? That's got to have a pretty, that's got to have an impact on property prices.
It does. Displacement of locals is a big issue. I was reading a report, actually. It was quite compelling. I'll just cite it because it was a real surprise to delve that deep into how regional growth is impacting locals who have been there for a long time. And the research is from AHURI. I'm sure there's an acronym word for that, but they just said that the research found that the people leaving cities are typically not young people at the start of their careers, but instead older people with more financial resources. So, these older people with more financial resources are breaking into these areas that have lower household incomes and raising that overall median household income stat. They're often seeking a better lifestyle and often become homeowners in their new locations. So what can be a win for someone, it can be a real challenge for another. And it's all about managing that change at a local level.
I think what we will see with the market in Darwin, if it's oversubscribed by property investors, is a reduction in the vacancy rate. And we have a look at the vacancy rates. Last July, it was 0.7% in Darwin, and we've just got the figures for July, and it's 0.5%. So,
not surprising.
I mean, it's only 0.2%, but if we end up having a sea of investors in there, that vacancy rate, it could be actually turning the other way. But, I mean, we were talking about
Seems
that
to take
Perth.
a while for that to
with
change.
Perth, it was it was months and months and months. We're saying so many investors are going in there, the market's going gangbusters, but the vacancy rate was still tightening, and it really probably took until the last couple of months we really saw that data. So that'll be an interesting thing to keep an eye on.
Yeah, well, we know it takes sort of 1 to 2 years for interest rate movements to actually trickle through into the economy and be seen as having an impact. And I think I reckon it'll be a similar time frame for things like vacancy rates, possibly even longer, because you've actually got to have people make major decisions to leave cities, to sell houses. That doesn't happen overnight. Just because, we're in this property bubble and ecosystem and talking property. We think things could happen faster, but they happen much, much more slowly. in the real world. So I think you're more likely to get lag effects 3 to 5 years down the track with these types of things. I think that'll play out over a longer period of time. So in terms of what you're saying with Melbourne, Cate, so like for this month's numbers, yeah, those mid-tier cities have jumped up again. Brisbane, Adelaide, Perth. But again, I've been tracking the actual growth since Feb 25, since the first rate reduction. So that table is Darwin at 8.4%, Brisbane 4.5%, Melbourne 4%. So Melbourne's had the third most growth over this Feb 25 to July 25 period. Now, you're not reading about that anywhere. We're reading 12 months, we're reading quarterly, we're reading 1 month. So Melbourne is the third highest performer since the first rate cut. So let's just keep watching this space. Sydney's fourth at 3.5%. Perth is fifth at 3% because Perth was really doing nothing for the first patch of this year and late last year. Then Adelaide at 2.6, Hobart at 1.8 and Canberra 1.7. So that, I think that I want to watch this table of how the cities are doing since the first rate reduction.
And let's put into perspective what I would call modest gains are doing to the big cities. So let's take Sydney as a case in point. With 0.6% growth in 1 month, that's not setting the world on fire, but it's solid. I think anyone would agree with that. Now, when we look at the median value, it's 1.228, which is eye-watering for every other state. But what that means for Sydney, if we're just looking at medians and doing some really rudimentary calculations, is that a house in Sydney is moving above $7,000 per month. So while you're out of the market, that's how much you're getting outpaced.
Yeah. And that's a solid number, a meaningful number for people if they're looking at that around that median price point.
Yep.
Yeah, and we're talking, 6.5%, 7.5% range if it's just ticking along at that 0.6 per month. I mean, that's not a bad result. I mean, that is probably outperforming the average to some degree, or at least being an average for an upswing, right? We're just kind of a bit spoilt by some of these 20% plus figures over the last couple of years.
Yes.
It's a good point. I mean, historical growth rates, depending on which platform you look at, but CoreLogic suggests around 5% is the historical national growth rate. So 0.6% is 7% per annum. You're outperforming historical averages. Plus, you've got your yield on top of that. So you're looking at probably close to a 10% gross return.
Yes. Yeah, that's right.
If we go to rents, pretty much everywhere is in positive territory. Melbourne is the lowest for houses at 0.7% and 1.7% for units. Unit growth, broadly speaking, seems to be higher than houses. I suppose it's a story of a lack of supply, but also probably, I think, people hitting their heads on affordability and potentially changing their behaviour. That was the thing that I was sort of all in on when we did our prediction, to say it can't grow at the pace that it did beforehand, not because there's more supply. It's just I think people are really, really close to that affordability point of view where it's like, okay, I need to get a renter in, or I need to think about a share house, or I want to talk to mum and dad about staying for another year or something like that.
I'm glad you've prefaced it with that, Mike, because I've had the argument with others who have just said, oh, I can't grow because affordability stops it. Affordability doesn't stop it. The decision to look at alternatives, which is obviously driven by affordability, that's what stops it. And we've seen household formation rates increase. We've also, particularly in Melbourne, seen all of those COVID bust-ups repartnering. We've seen people get new partners. And that's happening anecdotally. For me, I'm seeing it a lot. So I think that's the key there. Also combined with new arrivals, skilled migrants. We've had a slowdown in numbers.
Yeah, but it's still historically relatively high numbers as well, right? Despite
Yeah.
even the slowdown.
Yeah,
That
national
obviously kind
rents
of
rose again, 1.1%. So they're starting. There's some evidence to suggest they're re-accelerating once more. Certainly not up to the levels that they were at, but
Yeah.
they're up 1.1% over the last 3 months, ending in July. That's up from a recent low of 0.5% through the September 2024 quarter. So, that's more than double what it was doing late last year. If you annualize 1.1%, that's 4.4% annual rental growth. So that is, it's well above inflation. It's above wage growth. It's certainly above our meagre productivity levels. So it's continuing to be less affordable to rent. People do have to make tougher decisions, but this is also what happens when you lag with productivity. Your standard of living reduces. One function of your standard of living reducing is things like rents increasing faster than income.
Yeah, you're right. And if we have a look at houses, I know it's very, very early days and I'm zooming in with a microscope, but everything except Melbourne is showing a little uptick. If that trajectory continues, there's absolutely merit to what you're saying, Dave. It's Melbourne that's the standout slow down city, but it's for those reasons that I was talking about.
Which is interesting because we did see a reduction in rental bonds in Melbourne recently come through. So we completed some research. I think we talked about it in and around maybe February, where we predicted there was around about a net loss of 4,000 rentals just with the lack of investors going into the state. The number ended up being quite a bit higher than that because, of course, it was able to factor in people selling their properties, which we didn't necessarily have visibility over. So the rental pool has shrunk, but then we have seen a flurry of investor activity happen in Victoria, which could explain why it's not doing so well, but it doesn't make sense with what we were talking about with Darwin before and Perth with that lag effect. So there's a bit to unpack there.
Victoria is actually leading the pack on first home buyer activity as a percentage of all purchases. So there's something going on there that we can't ignore either. I know that the intent when the government was facing the situation where investor-led sales were taking place, the argument was that it gives opportunity to buyers to get their first property. And not every single investor-led sale's gone to the hands of a first home buyer, but we have definitely had an increase. And we've got a representation that's stronger for first home buyers in Victoria than other states.
That's an interesting one because I suppose if people are leaving the rental pool to buy their first home, then there's less demand for rentals. But we kind of need to know the breakdown of, okay, well, where are these people come from? Were they living with mum and dad and then buying a property, or were they in the rental pool? I would assume the majority of them are in the rental pool.
If it's interstate migration, the numbers of interstate migration, potentially first home buyers seeing Melbourne as a place to secure a good paying job and then buying their first home in Melbourne because the prices are relatively low. That would be interesting as well.
Got a little bit more to look at there. Gross rental yields, we're looking nationally at 3.7%, combined regions at 4.4%, and combined capitals at 3.5%. It's still probably telling us that anywhere you go is likely to be a negatively geared property if you're doing anything upwards of an 80% LVR, except maybe regional Tasmania and possibly Darwin. Any insights from the rental yield print?
Yeah, we didn't talk about this last month, but for the first time, Brisbane, which was always in line with Adelaide and Melbourne at 3.7, Brisbane's dropped to 3.6. Subtle, but I could pick it because those three were streaming at the same rate. That means that Brisbane's rate of growth hasn't kept up with its rate of rental growth.
That's an
Sorry,
interesting
other way
one.
around. Its rate of rental growth hasn't kept up with its rate of capital growth.
Yes, yeah. And I mean, the capital growth has been galloping along, so it kind of makes sense that yield would be shrinking. Uh, we touched on vacancy rates before. I mentioned that Darwin has dropped to 0.6%, sorry, 0.5% from zero point 0.7 before. We've got a slight tightening month on month. So from June to July, we've gone from 1.3% to 1.2%. But a really interesting spread with Sydney at 1.5, Melbourne at 1.8, and really everywhere except Canberra being under 1%, which is very, very tight. And, nationally at 1.2%, there would be a lot of people that say, well, these are crisis levels of rental accommodation. And now we've got the economic taxation roundtable talking about all the structural problems with tax and housing, and CGT and negative gearing is on the table again. Yet when you look at the costs of bringing new dwellings to the market in terms of, say, greenfield sites across the states, the increase is around about 30% in the taxes in the last couple of years. So for me, there's bigger problems than negative gearing when it comes to housing supply. What do you guys
Definitely.
think?
Well, if we look at these numbers, you've cited Melbourne at 1.8, which is actually the largest vacancy rate nationally, and then Sydney at 1.5. The total number of vacancies in both of these cities is just over 9,000 and just under 11,000 respectively. So that's a lot of houses. I'm not suggesting that we haven't got an issue. But what I'm contrasting that to is Darwin, 126 houses were available for rent in July. That is why we have increasing rental yields in Darwin. That's not enough houses.
Mm. And Hobart, very, very tight as well. Yeah, with Hobart, with population of approximately 250,000, I mean, only 155 rentals available. That's very, very tight as well. And sticking with the Hobart case study that I've been running with for a while, I'm interested in what you guys have to say about the listings data. It's a sea of red if you're looking at the tables yourself in terms of total property listings everywhere has contracted for the month of July. It's a bit of a different story with the yearly change, a bit of a mixed bag. Darwin, 36.7% drop in listings, which kind of speaks to that galloping away of the capital growth. Perth, 17% up. So that's kind of, I suppose, evidenced in the downturn we've seen. I mean, it's still growing. It's still at
Yeah,
the
their
peak, but the
rate of
pace of
growth
growth, yeah,
has slowed.
it's come right off. And then, Hobart, it's actually up 1.4%. So a real mixed bag for total property listings. Who wants to weigh in on that one?
You see Melbourne, Brisbane and Darwin are the ones in negative territory. So the number of listings have fallen relative to 12 months ago on from a total perspective. We know there's historically and often a good correlation between less listings and stronger price value growth. So yeah, and Darwin is a perfect example, as you alluded to. If we look at new listings, people have stopped putting their houses on the market in Brisbane, which suggests it might be ready for another rebound. Adelaide, Sydney and Melbourne are just in negative territory. What's interesting is Darwin's jumped up with new listings. So it appears, even though total listings, a lot of people have bought all the old stock, people who've been probably holding onto properties for a decade or longer in Darwin and have had no growth are going, okay, now's the time for us to sell and get out of here with a 16% jump. So, yeah, it'll be interesting to see what that does to Darwin. But, yeah, people are obviously seeing the opportunity to sell.
We've talked a little bit about the Canberra market. It's in the toilet right now. With all due respect, it's not performing very well. And, it happens to sit side by side on the list with Darwin. When we look at the old listings greater than 180 days, that tells a real different story about how those two markets are humming along, Cate.
Yeah, the greater than 180 days listings figures I find really valuable. And you can see when they're harshly depleted that buyers are scrambling and buying old stuff. Now, in Darwin, they've had such colossal growth. If a good quality asset has been sitting with a price tag that's too high, that market has sorted itself out because ultimately someone's gone, you know what, Bob's been asking for, $600,000 for 5 years now, and it hasn't been worth 600, but now it's worth 620. I'm going to buy it. So these old listings aren't necessarily bad assets or compromised property. Sometimes they're just priced too high with an unmotivated vendor. But it does worry me when you see data like that showing such a strong uptick in the depletion of old listings. It has to be that some investors are just grabbing junk, compromised properties. I do wonder about the asset selection, the quality of them, and, the checklists that buyers are sticking to when FOMO is rife and stock level is really thin on the ground and old listings are still floating about.
And when we look at old listings as well, we see Hobart having a better month with 6.9% decrease in old listings, but still the yearly percent is up 21.5. So that, maybe that is coming down when you look at distressed listings as well, a very small sample size for a place like Tassie, but that's contracting as well. Dave, are you prepared on record to call the bottom, or have we got a bit to go?
For Hobart?
For Hobart, yeah.
Look, I'm not prepared yet. There's not enough evidence to say.
I tried my best to pin you to the wall on that.
I'm not either, Mike. Nice try.
Look, it must be very close. I'd say the same for Canberra too. There's been little bits of data that have been promising for both of those cities, and not the least of which rates falling for every capital city is helpful. So we'll keep watching this space.
We'll keep watching, absolutely. Stick with us. Every month we'll give you our update and we'll keep a close eye on that. Unfortunately, we haven't got some sentiment data for this particular episode, which is always good to add some flavour. Let's talk about the RBA decision. So a 25% basis cut, that brings us to a total of 3 25% basis cuts. So anyone that doesn't have a calculator, that's 75%. And Governor Bullock has flagged that there's a couple to come. We've got the employment statistics in as well, and she referenced that in her speech to say that there's been an uptick in unemployment, but historically speaking, it's still very, very low levels. And that's the fine line that they are trying to tread. They want inflation back within the target band sustainably. With interest rates cuts, there's potential for the unemployment rate to uptick, but there's still room to move for it to even be at its historical average. What were the takeaways that you guys had from listening to Governor Bullock speak on the rate cut yesterday? Cate.
I'll go first. I think she's been so cautious about hinting that there'll be any rate cuts, for her entire time as our Reserve Bank governor. And yesterday was the first time she's actually been vocal and, pretty out there with it. She literally said there have to be a couple of cuts for us to not risk having our inflation drop below the target band and to risk unemployment tricking up to an uncomfortable level. So she was on the record saying to stay on target, there will be a couple of cuts, or there need to be a couple more cuts. And the inference is another one this year and maybe one early next year. I don't think anyone would want to put their head on the block and detail exactly when that will take place. But her key concern...
unless you're an economist.
Yeah, that's right. We saw what happened for Governor Lowe. It didn't go well when he predicted long range and said something that was, very, very direct about how long we'd have a low interest rate environment. He was hung, drawn and quartered over that. So I think everyone's being very careful not to do that. But she talked about productivity being the concern, and productivity has dropped. And I know you'll chat about that, Dave. But I thought it was really interesting that she was very bold about the fact that there's more rate cuts to come.
Yeah, that is unusual, isn't it, for the governor to be so open that there's 2 more rate cuts to come, because, everyone's then going to jump to that.
Spend like there is.
Exactly. Yeah, 100%. And the last meeting, one of the things that appeared they were concerned about was, and maybe the meeting prior, the property market's reacceleration. So they were just conscious of that. And I think part of it might be speculation, but part of why they just held on, obviously they wanted a bit more of concrete data, but why they didn't reduce at the last meeting was just to put a bit of a dampener on the property market as well, I thought. So, yeah, for them to now come out and say 2 more rate reductions are a fait complete is quite a surprise.
It was bold. It was different to last month. They were really cautious last month. I think they were still waiting on a couple of extra data pieces. In fact, I'm sure that's what was going on. But we all thought it was compelling, and it's intriguing seeing what the markets are happy to run with and predict, and what the journalists are reporting based on what's being predicted. I watch Rate Tracker all the time, and not because I think that it's necessarily telling us what will happen. It's a leading indicator, but it's not a predictor. And the reason I say that is the number was bouncing around the 50 to 55% chance mark for a double rate cut. And even, as at yesterday morning, it was saying that the odds were slightly more favourable for a double rate cut, but it's generally been more bullish than what the RBA have ultimately decided. So I'm always cautious when I look at Rate Tracker. It's interesting to see how the markets bounce around and show us what they think, but it doesn't always translate.
They're always forward-looking, aren't they, the traders?
Yeah.
So I think the implied yield for December that traders are paying for is 35 basis points below the current rate of 3.6. So they're expecting at least one rate cut, and they're hedging. It's almost halfway between having a second rate cut by the end of the year, just slightly beneath that. One thing that we do know is the RBA does all this modelling on what they estimate the neutral rate to be. And the neutral rate is when you've got the cash rate at a level that is neither inflationary or deflationary in theory. So it doesn't cause inflation to go up or down. And in theory, it's the perfect interest rate where you can just sit for a long period of time. Some of the modelling implies that being at 3%. So we're currently at 3.6. And so I suspect, given that is public knowledge, that's why she's a bit more comfortable to say there's a 50 basis points still to come to get us down to 3.10.
We think in 25 basis points segments a lot, but remember when 10 basis points was a movement that we could see? I don't think it's beyond the RBA doing that. If they think that they're fine-tuning and getting close to that equilibrium rate, I anticipate they'll reduce the number of basis points below what we've been accustomed to really fine-tune it, because it's such a delicate lever once you get in close, isn't it?
Yeah, or they might move one by 0.35% instead of 0.25 if they want those round numbers and get to 3%. Yeah.
Yeah.
So, and productivity, she said was a concern. So just for our listeners, productivity increases when more output is produced with the same amount of inputs, or when the same amount of output is produced with less inputs. So said in layman terms, we get more done with less. And really, it's increases in productivity is the greatest driver of wealth improvements in a country. It's and it's been really been anemic for the last decade. So like 95 to 99, we had average productivity growth of 3%. The 2000s to 2009, 1.8. It dropped down to 2010 to 2009, 1.7%. And in the 2020s, average growth is, now getting down closer to around 1%. So that doesn't augur well for our increases in standard of living. And that is a concern that Sandra Bullock, not Sandra Bullock.
You're thinking Miss Congeniality again.
Oh, you love that bus movie, don't you, Dave?
There's a bomb in the van, Dave.
Keanu, Michelle Bullock. Yeah, and it's good to hear her speak about that, to be honest, because the government have been sort of slowly dragged there to talk about productivity. They're obviously having their catch up with business leaders and union leaders very shortly, and it's something we do need to talk about as a nation. Otherwise, we risk being the lucky country, and the future that our children will inherit won't be as good as the ones that we've been lucky enough to inherit and grow up living with.
Yeah.
The Economic Roundtable obviously is on at the moment, and the media is really just focusing on the tax changes at the moment, but it's all about delivering productivity reforms from red tape reductions, especially in construction, but AI adoption and infrastructure development to support that as well. The Treasurer's got a $900 million national productivity fund. And the Productivity Commission itself is supporting a company tax cut to 20% for most firms to stimulate investment and entrepreneurship, and then also a 5% net cash flow tax that will try and, I suppose, mitigate that to some degree. They're also talking about a hybrid work from home model being more widely adopted because they believe that doesn't harm productivity. And also they're talking about a national lesson plan database for smarter AI use in schools, because really the educational reforms that they're talking about are required, because we've already seen some evidence that the Productivity Commission is citing with AI. For example, the CFOs that use generative AI as a key tool, they're reporting 5.3 hours saved weekly, and 85% of finance chiefs cite productivity gains as the chief AI rationale, though only 30% have implemented generative AI in finances yet. So the gains are there to be had, but right now there's a little bit of a gap. I mean, ChatGPT is a text in, text out kind of calculator that calls workflows. There's a lot of customization that you need to be able to park that over your business case. But with GPT-5 that's recently come out, it's much more sophisticated in terms of its communication model, its ability to analyze, say, profit and loss statements, which I've tried in the past with zero success with GPT. That space is moving so quickly. And when we're talking about these AI agents that you can kind of build with no code or low code providers like N8N, for example, I think GPT is going to go to that direction where we will probably all have AI agents that help us. So, for example, if we need to book in a podcast, we can talk to something and say, could we try and book in a podcast for Thursday, check my calendar, and then send it to Dave, and then they'll talk to each other, and it can sort of happen without us. I think that is the future. It's a very interesting space, but we're not there yet.
Yeah. And look, and if we don't have that productivity increase, it means our income, in essence, is growing slower than the cost of goods and services. So you get less bang for buck from your income. That's what it looks like on an individual level.
Mm.
Yeah.
Well,
on that note,
that was the month that was July 2025. If you're a journalist listening to this, all you need to say is the property market is booming. It's up in every capital city. Obviously, that's not the way that we communicate or endorse. So stick with us for the market update every month, and we'll give you the behind-the-scenes, nuanced data for the sophisticated buyer. Isn't that right, Dave?
That's it.
You said it, Mike.
We'll see you next week.
See you guys next week.
See you later.